Hi there, everybody. Happy Thursday, February 27th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny Redmond, Washington. 61 degrees outside here, a far cry from a windy, rainy couple days we had after a snowy, freezing couple weeks we've had here. So great to see some beautiful Pacific Northwest weather happening right about now. I would tell you, I feel like the storm clouds and rainy conditions we were experiencing in the Seattle area appear to have been translated into the market conditions because the S&P, the Nasdaq, all rotating to the downside earlier in the day. What felt like the continuation of a sideways trend, and now starting to accelerate to the downside. We have a number of macro issues all kind of coming to a boiling point. And you probably know what they are, but if you've been buried in a hole somewhere and have not paid attention to what's going on, tariff headlines continue to hit. Earlier discussions of tariffs met minimal resistance from the markets. Now all of a sudden, I feel like investors recognizing the potential inflationary impacts of these tariffs actually coming to pass here very, very soon, as early as next week, really. The second thing would be, a lack of confidence in the AI trade, right? The semiconductor space rotating lower. Nvidia with strong earnings yesterday. I mean, overall, if you knew nothing else was going on in the world, you just looked at the Nvidia's earnings, probably feel pretty good about prospects for Nvidia. Probably feel good about what that most likely means for the market. If you think about 2024, leading company, mega cap stock, strong earnings, strong outlook, markets going higher. We're not getting that. So when stocks sell off to the degree that an Nvidia does after a strong earnings report, that tells you it's less about Nvidia's ability to grow their business versus expectations. It's more about investors willing or interested in taking on additional risk. That is some of the warning signs we've been talking about, going back to the end of last year, talking about the Hindenburg Omen, talking about bearish divergences. It's all about at what point is there a lack of confidence of further upside. We talked about limited upside potential and the potential for further downside. And I think we've seen a lot of those signals come to pass. Early 2025, it's been about leadership rotation. We did a webcast yesterday morning talking about, or afternoon Eastern time, that is, talking about the great rotation of 2025 away from kind of mega cap growth stocks and into other areas of the market. I would say we're kind of seeing that here yet again today. As we bring up the charts and go through the review, do want to let you know we did have a new episode of the Market Misbehavior podcast just posted about a half hour ago, maybe an hour ago. I sat down virtually with Jay Woods of Freedom Capital Markets. I've known Jay for a number of years, longtime market maker on the floor of the New York Stock Exchange. Still based in the New York area and doing a great job. He's on media pretty much every day that I can find him. He's going to some studio and talking about the markets. He does a really good job. And we talked a lot about conditions. He did sort of a mini masterclass on analyzing the S&P. We talked about the 100-day moving average, which I'll share with you in a moment. But, the idea is, just talk about a sign of the times. And when we're talking about, best ideas and where to think about potential upside, it wasn't in the growthy sectors. We weren't talking about technology or communications names. We were talking about consumer staples. We were talking about financials. We were talking about materials. And there's some great charts in each of those sectors that we went through together. So I'd encourage you to check out that interview on our YouTube channel. It was a lot of fun. Again, just posted less than an hour ago with Jay Woods of Freedom Capital Markets. With that in mind, it's funny, as I was talking with Jay, it was just before this big downside rotation that we saw in the major averages. So from the time the interview was done until getting ready for the show, I feel like the whole world sort of changed a bit. But I think this is telling, to be honest with you, right? A lot of days have had this kind of configuration where you rotate lower, and instead of finishing in a position of strength, we rather finish in a position of weakness. And that's really more common in bearish phases than in bullish phases, for sure. Let's look at the damage. The S&P, look at that. Almost hit my line in the sand, a level which appeared to be nowhere near the market action, just a week or two ago. All of a sudden, 58.50, very, very close to today's close. We didn't quite get there. We finished just above 58.61. That's down 1.6%. The NASDAQ composite leading the way lower, down 2.8%, finishing just above 18,500. Mid caps, small caps, all in the red as well. The only thing on the green is the VIX, and the bad news there is the VIX moving higher is usually not a great sign for stocks. The VIX pushed up a full 2 points higher to get above 20, and 20 is that line in the sand. We've been talking how many times, I feel like a broken record on the show. I've been mentioning until and unless the VIX pushes above that 20 level, we're still in a low volatility environment. We're not anymore, according to today, right? VIX over 20 means high volatility environment. That is one of the things that I look for as a big warning sign, suggesting that investors are getting very nervous and are starting to trade nervous. And that is usually does not resolve to a bullish phase for stocks. Looking at interest rates, bonds actually sold off today. So this was interesting because the trend over the last week or so has been weaker stocks, stronger bonds. Today, actually, both of those moving lower. So the TLT, which is a bond ETF, Treasury bond ETF, down by about 0.7%, we'll call it. Interest rates generally moved higher today, particularly the longer duration Treasury. So 10-year yield are just below 4.3%. The long bond yield back just above 4.5%. Dollar index may be something to watch here because the dollar index has been trending lower here in the last couple of weeks. In the month of February, stronger dollar that occurred from sort of last fall through the beginning of this year has started to change, and you've seen the dollar trending lower. Today, popping higher a bit. I would be watching that chart. I don't think I grabbed that for the chart review, but watching that for a potential breakout above trendline resistance to the upside. Breakout in the dollar could certainly coincide with a bearish rotation. See early 2022 for an example of what that could potentially look like. Don't know if that's going to happen for sure, but that's certainly one of the things that stands out to me as I reflect on the beginning of that year. Gold and silver moving lower. Gold not being much of a safe haven today. The GLD was down about 1.5% to 265. The silver ETF SLV down almost 2%. Crude oil prices actually moved higher today, and you can see the energy sector was one of the few that actually finished in the green today. Looking at the top commodity ETFs, kind of a mixed results right about now. Going on to cryptocurrencies, crypto's continuing to be, basically trade with risk assets. I remember earlier days on cryptocurrencies when it was still unclear as to what Bitcoin would do in an equity bear market. I remember some people speculating that it could be kind of like gold, right? Gold actually moves very differently, has a very low correlation to stocks, not a strong positive correlation, not a strong negative correlation, but kind of a low correlation, meaning there's not much relationship between stocks and gold. And that's one of the great benefits of gold is that it doesn't do things very much tied to stocks overall, right? The relationship is very fluid. I remember seeing something speculating that maybe Bitcoin would do a similar thing. That has not been my experience so far as I've been following cryptocurrency since their inception and having grown in popularity. Cryptocurrencies tend to be, in my opinion, more of a leverage bet on risk assets. It's like a leveraged equity ETF in some ways. So I would say I don't know if collapse is the word that I would use, but definitely the breakdown in Bitcoin from 108,000 down to the low 80s really tracks the deterioration that we've witnessed in equity markets. It's interesting though that Bitcoin has clearly broken down before the S&P or the Nasdaq are breaking their own lines in the sand. So perhaps it's a leading indicator telling you there's more weakness to come. Not sure, but cryptocurrency is certainly not looking particularly strong here. To generalize a bit. All right, let's look at the 11 S&P sectors, 3 of them finishing in the green. Financials, energy, real estate, all up about 0.5% today. So not a great update, but certainly moving higher while other things are not. The rest of the S&P sectors were all in the red. Staples were basically flat for the day. That was essentially an unchanged day. So we'll call it 7 of the 11 moving lower clearly. Technology at the bottom of the list down 3.6%. And that was, again, sort of got worse and worse, in like a really bad football game. And you just want halftime to get there. So like this team just needs to get off the field and regroup. I feel like that was technology going into the close today. It was like, we just need the bell to ring so we can take a breather, lick our wounds and try again tomorrow. So the XLK down the most, 3.6%. Utilities, which more and more feels like a growth sector tied to technology, down over 2% today. Consumer discretionary, third from the bottom, down 1.4%. The problem for the XLY is a similar problem that you see in some of these other ETFs, which is they're very top heavy and those top names are struggling. The XLY, about a half of that ETF in terms of market cap weight, are Amazon, which has been in a downtrend in February, Tesla, which is arguably the worst chart out of the Magnificent Seven names, clearly in a downtrend as well, and Home Depot, close to confirming a head and shoulders topping pattern. I believe I mentioned that on the show yesterday. I wrote an article digging into a little more detail on that theme on CNBC Pro earlier today. So if you follow my work there, you can check out some of the details in the charts that describe that potential breakdown. But, two of the three bottom sectors are some of the biggest sectors, and certainly some of the growthy leadership sectors that, again, more and more days like this just confirm the fact that we're at the least in a leadership rotation, at worst in the beginning of a bear phase. Breadth overall pretty negative. We've seen some days here in the last couple of weeks where one of these, like the Nasdaq, will have very different breadth than the S&P. This is not one of those days. This is one of those kind of everything looking very similar and not great. The S&P 63% decliners versus 37% advancers. The Nasdaq Composite a little bit worse, almost 70% down to 28% moving higher. So this is very much a distribution day when you look at breadth conditions. I did grab a couple breadth charts to review in a little more detail. I also grabbed a chart of the market trend model. Now, this is a model I only update once a week, but I want to bring it up because the medium-term trend model, which for me, the medium-term trend based on the S&P 500 is my main kind of risk-on, risk-off gauge. So when the medium-term trend turns negative, that tells me to start going risk-off and thinking more defensively and focus on capital preservation instead of capital growth. It's not quite there, but if we have another big down day tomorrow, it could certainly trigger by the end of the week. We'll certainly keep a track on that, but I will show you the chart. Worth noting, though, as of last Friday, all of the major U.S. indexes bearish in the short term. 2 of the 4 already bearish on the medium term. The S&P and the Nasdaq 100, arguably the most important in terms of how most people are positioned these days, not quite there, but certainly something to watch actively. The Magnificent Seven, the Lag Seven, the Meager Seven, we'll call them today. Really living up to their new moniker, rotating to the downside. I mean, I think if books are written, if this ends up being a significant top, and if 2025 ends up being a really rough year, a la 2022, I think one of the chapters in this book will be Nvidia in February of 2025. And I would say the fact that Nvidia has been sideways for so long, which it has, right? If you look at the chart of Nvidia or the chart of semiconductors, both of which we will look at in a few moments, this has not been in an uptrend for quite some time, right? And while it feels like a big down day today, which it is, we have to remember that Nvidia has been a nothing burger, which is a very, a technical way of describing a chart that's going sideways, right? Charts can go 3 directions: uptrends, downtrends, or sideways. Nvidia has been sideways. Semiconductors have been sideways. Arguably, the S&P 500 has been sideways for quite some time here. So this is a market that is really stalled out post-elections. And while things have kept making new highs, it's been in the least bullish way possible, on weaker momentum and weaker breadth. And so I would say the story of this week, by my perspective, and again, there's still more to come with PCE, with inflation data next week. But I would say at this point, Nvidia doing what it's doing now after having pretty good earnings. I mean, the earnings read like one of the bullish AI-driven earnings reports from 2024. And I feel like that same message in July of 2024 just causes this huge upswing where things rip to the upside. The exact same report in February 2025 is met with selling, right? People are like not buying it. That the optimism has already been priced in. I need to get out of the way and minimize my losses. So Nvidia down 8.5%. We will look at that chart. We'll talk about some particular levels here in a few moments. Tesla down another 3%. Netflix down another 2.7%. Meta, Alphabet, Amazon all down over 2%. All of these stocks were down today. And again, there were things that were up, and we'll see it in a few moments when we look at the market carpet. But it's not the stuff that was leading in 2024, to be sure. By the way, if you did watch my webcast yesterday morning, I'm so glad that you joined. We actually have the replay ready to go. We'll be emailing out if you signed up for the event. You'll get an email here very, very soon if you haven't already, with instructions on how to access the replay. But I appreciate everyone's interest and participation in that discussion about rotational developments. So we'll hope you enjoy the replay as it comes out here. One great note and a shout out and a thanks to my friends at the Stock Charts. I reached out to them after one of you on the show a while ago noticed, hey, where's Palantir? And all of a sudden I talked to my contacts at Stock Charts who realized actually that's where we have the old S&P members showing on the chart. That's now been changed. So if you tune in, you will see Palantir. You'll see all of those newer S&P names reflected in the updated version of the market carpet. So I appreciate you mentioning that. The astute viewer who pointed that out, you were absolutely right. That's been fixed. So thanks for that. Looking at the market carpet today, what stands out? I mean, a lot of red in a lot of rough places. But I would also note, look at all the green on this chart. I mean, on a down day, which feels like kind of an end of the world kind of move for growth stocks, look at financials, look at healthcare, look at staples, look at real estate, look at materials, look at energy, look at industrials. This was not that bad of a day. It was that bad of the day for the biggest names, unfortunately, with the biggest weights and the biggest sector, technology. For all of those, this is a pretty rough day. So, this is not yet a everyone selling everything kind of market. And I will tell you, mentally rewinding, I was talking with Jay Woods in our interview earlier today about, the financial crisis, kind of talked a little bit about that period and what kind of things we saw. And I remember looking at a heat map like this. It was all red, and it was like kind of red to very red. And those were the days that you experience in a significant kind of waterfall decline. Financials were up today, right? And if you look, I mean, the average stock did okay in that sector. And I would say across the board in the non-growth sectors, this wasn't that bad of a day. It's just the biggest sectors and the growthiest sectors, and where many of us probably still have a little too much exposure given the signals that we've observed. This is where we're feeling the pain. So in the technology sector, clearly the worst of the bunch. This is down the most. Broadcom down over 7%. Nvidia, of course, headline breaking down about 8.5%. Still above that late January, early February high, but certainly breaking down. Salesforce, which is another one that reported yesterday. The bull scenario, I would say this week, was Nvidia and Salesforce having good earnings and then getting a nice bounce higher. And neither of those, those things did not happen for Nvidia or for CRM. CRM finished today below 3%. That's down, below 300. That's another 4% below yesterday's close. That's after reporting earnings on Tuesday. A lot of these other names, semiconductors in particular, just continuing to rotate lower. Palantir, which has been one of the greatest stock stories of the 6 to 12 months leading into February and mid-February of 2025, just turning on a dime and rotating lower, down another 5%. I mean, the problem with a lot of these names that had such significant runs is you leave yourself, when they become more and more, exponentially rising, you leave yourself more and more vulnerable to a big, rotation to the downside. And that's what we saw with Palantir. So if you wrote it up, that's great. But if you're writing it down, that does not feel as great. And that's why one of the things, I was trained to look for was look at the distance between price and the 200-day moving average, and just look for when we're really far away on a percentage basis. That's how you would describe Palantir and other names that start to go vertical. That's when things start to go vertical. You kind of want to start trimming to just prevent riding it all the way back down in case we have a quick downside rotation. In the consumer discretionary space, of course, Amazon, Tesla are your two biggest weights. They're down a bunch today. In communication services, your three biggest weights are Alphabet, Meta, Netflix. Obviously, those are all down 2 to 3%. But then look elsewhere at AT&T making a new all-time high today. Looking in the industrial sector, Raytheon, a defense stock, making new all-time highs today. Look at Berkshire Hathaway, biggest weight in the S&P 500 financial sector, making new all-time highs today. So, if you're struggling to find stocks that are working, I would say you are struggling to expand your thinking outside of the growth sectors. If you limit your universe to tech, discretionary, and the big consumer communication services names, you're probably feeling like everything's going down. There are things actually doing quite well still at this particular moment. It just represents a rotation away from some of the things that had been working so well in 2024. All right, shall we finish off then and look at the chart review and look at some of the damage that we experienced? I have to bump out some of these lines here just to see where we're at relative to these key levels. I kind of have two levels that I'm watching on the S&P, 6,100 on the upper end, The purple horizontal line here is 58.50. That's the line in the sand we've been talking about now for quite some time. If you look at the chart of the S&P, you can see we traded on an intraday basis almost exactly down to that line in the sand at 58.50. We ended up around 58.61 and change. And again, I would consider at this point this week is at least yet another retest of that 58.50 level. So going into tomorrow, going into next week, does that level hold? And if we go into the weekend with that level being broken, I think that's a pretty negative sign. So, I mean, the bear scenario for me going into this weekend, and for my Market Misbehavior Premium members, buckle up, because I'm sure our discussion will be very cautious and talking about downside objectives and getting defensive. That's if the S&P finishes below 58.50 and our medium-term market trend model turns negative. Both of those things are possible. It would have to be a pretty steep sell-off tomorrow, but that is absolutely possible. If we have a nice counter trend bounce, I think we'll still be in an open question. Think about this range on the S&P. So all eyes for me and for many on 58.50. Again, another thing to observe, obviously after the bearish divergences we've been observing December, January, February, we're now seeing the RSI break below 40 this week. That's not great, because in a bullish trend, you usually see the RSI stall out around 40. Breaking below 40 on a pullback is usually not a great sign. I mentioned my conversation with Jay Woods a couple times. Again, I hope you can check that out on the Market Misbehavior podcast. But what he and I talked about when we're talking about the S&P, he said, you know what, can we put the 100-day moving average? Because that's actually been a really important moving average over the last 12 months. And he's absolutely right. I don't look at the 100-day often. Grayson Rose, friend and former colleague at Stock Charts, swears by the 100-day moving average, among others. And I'm just not, my toolkit did not include the 100-day as I was going through my formative years as a technical analyst. But I can't deny the fact that it's been a pretty important level to watch here. And you can see pullbacks a number of times have found support at an ascending 100-day moving average. It noticeably didn't in July, August of last year, but it very quickly rotated. And that gap day below there, we actually closed higher and then just sort of returned back before eventually making a new all-time high in September. So breaking below the 100-day all of a sudden makes this look, again, at least like a very strong pullback that we've experienced going back to the beginning of 2023. Regaining the 100-day is sort of what reinitiates a bullish phase. But for now, this is looking like a breakdown. We talked about the newer Dow theory a number of times recently. I just want to point out it's not quite signal to sell signal. So I have a market top checklist that I track, and one of the the last three items all deal with confirmation, and validating whether or not we hold key levels of support. And one of the items on there looks at Dow theory. And the idea of Dow theory is you look at two different indexes, and when they confirm one another by breaking down. The early warning sign, one of the things you look for as a leading indicator is what's called a bearish non-confirmation, which I would argue we've gotten here in the month of February. The question is, do we break to new swing lows? That means the equal-weighted S&P breaks below 173. That means the equal-weighted NASDAQ 100 breaks below 89.50 or so. And if that would happen, that would be a confirmed sell signal, in my opinion, by what I call the newer Dow theory, looking at the S&P and the NASDAQ using equal-weighted versions of those two ETFs. Not quite there. And so I think the breakdown doomsday scenario, not completely playing out yet, but I would say it seems like a more and more likely outcome given the disruption that we've experienced so far this week. My market trend model, as I've mentioned many times, is a key part of my own approach to investing. As long as the medium-term model remains bullish, I don't think things are getting that bad. When it does, I've learned to get defensive and think defensive, and focus more on capital preservation than capital growth, as I like to say. The medium-term trend model is just narrowly remaining bullish as of today's close. I don't formally update the model until Friday's close, which means tomorrow I'll certainly be looking to see if that level will hold. And again, with my Market Misbehavior Premium members, what we will be doing here in the weeks to come is focusing on that market top checklist, focusing on each of those 7 criteria, navigating together and identifying when they are checked. So if that's something you want to do together, and if you need help figuring out this particular market environment, always happy to have one more member. Go to marketmisbehavior.com/premium and check it out. Make sure you use the code YouTube if you do, and you get a special deal on the first 12 months on any plan. All right, looking at the S&P 500 breadth data. We've highlighted breadth in a couple different with a couple different charts here recently, and today we're going to look at the percent of stocks above their 50-day moving average, which today just broke below the 50% level. It's kind of my basic measure of above 50% bullish, below 50% bearish. There are other ways that I use this, but that's kind of the basic litmus test that I use on any kind of trend analysis using breadth. And as of today, we've broken briefly below that 50% level. It happened a couple times earlier in the month of February, but we didn't really hold that. So I would say if we continue lower, that's where this starts to look like a more significant correction. The real bearish signal is if the percent of stocks above their 200-day breaks below 50. The S&P 500's own 200-day moving average is currently around 57.16, trending slightly higher. Most stocks in the S&P are still above their 200-day. We see further days like we saw today. We will see that number quickly go below 50%. The last time we had that kind of sell signal was here in September of 2023, which confirmed that bear phase, cyclical bear phase going into Q4 of that year. Well, I was watching the Chaikin money flow going into the close. We started a little late today because I had a lot of charts to review just because so much was happening in the last half of trading today. Most of the days in the last week for the S&P 500 have been down days. The Chaikin money flow is really looking at where we close intraday between the highs and the lows. And days like today, days like we saw about a week ago, where we sell off through the course of the day and close near the lows, really cause a negative movement on the Chaikin money flow. It's just barely holding above zero. But it is very close to breaking that level. Chaikin money flow breaking below zero. Again, not necessarily the end of the world. We saw a couple signals there in Q4 that didn't end up being really painful declines, more tactical pullbacks. But any of the big corrections that we've seen in previous years usually are represented or confirmed by the Chaikin money flow going negative. That suggests institutions distributing or negative pattern of distribution based on the price volume relationship, not quite getting that sell signal, but very close to doing so today. Speaking of red flags that were being waved today, the VIX finally getting above 20. I feel like for the last couple months, I've been talking about, until the VIX gets above 20, there's probably not too much to worry about. There might be a little bit to worry about here today because of the VIX finally pushing above 20. Now, we saw a couple times here in the last 6 months where we've gone briefly above that 20 level and have come back. But again, the real bearish scenarios, like if we go back to 2022, we push above 20, we don't stop, and we tend to accelerate. The last time we really had that kind of acceleration, again, was in the pullback in mid-24. The VIX actually spiked a lot higher on an intraday basis. On a closing basis, it pushed just above 38. But that sort of move really tells you we're in a dangerous scenario. Now, what you look for are signs of stability, signs of a short-term bottom, a V bottom like we experienced in early August of last year. But the pop above 20 tells me there's an increased likelihood that we go down a lot further. The reality is the market just usually, if not never, sells off significantly without volatility increasing, without the VIX pushing above 20. That's why for me it's a level to watch. 2850, which is that green horizontal line. Years ago, I interviewed Tim Hayes of Ned Davis Research. Ned Davis is known widely in the financial industry as being one of those great long-term analyst strategists. They have a fantastic data repository and repository of charts on their website that I used to use every day. And talking with Tim Hayes in their analysis, looking at deep history of the VIX, 2850 was like the cutoff for them. Anything above 2850 means we're probably going to have, the forward returns in that scenario are usually pretty bad. So August of 24 was actually very much an outlier in the fact that the VIX spiked up to the degree that it did. And stocks recovered so quickly. Usually that's the sign of a very dangerous market environment. Again, we're going to run out of time of crazy charts to show you today, given the acceleration that we saw going into the close. But boy, sentiment data had a big shift today, particularly the AAII survey. If you look at the survey today, you can see that bears increased big time. The bears increased from 40% bearish to 61% bearish today. And I almost had to double check it. It was such a negative number. That's one of the lowest or one of the highest readings I've seen for bearish data going back in the deep history of the indicator. You rarely see above 50 and you super rarely see above 60%, which is where we're at today. Now, before you get all excited and think, all right, Well, the last time we were that low was at the September low of 2022. That's bullish, right? I would point out the in April of 22, where we got down to that level, in June of 22, where we got down to that level. So a lot of these lows saw the sentiment get really, really negative. And that's the danger of just blindly using an indicator like this as a contrarian indicator. Sometimes it means we're just at the beginning of a pretty bearish phase. And that's the problem. That's why I think you want to switch into trend following mode and just track levels to see what's happening. In terms of bullish sentiment, we've been going down for the last 6 weeks. We're currently just below 20%. If you look to the left, you will see, this is one of the lowest readings we've seen in the last 5 years. So the individual investors in the AAII survey rotating to some of the more bearish readings that I've seen in the history of the indicator. That could mean we're at a big contrarian bullish signal after a sell-off is over. The problem, though, is that also has happened early on in protracted bear markets, and that's why I'm a little hesitant saying that that's anything but more negative at this particular moment. The name exposure index noticeably did nothing that negative. The name exposure index currently sitting still around 88%, which suggests that respondents in this survey really not getting that negative, even with the deterioration that we've observed so far this week. We'll see what happens in the weeks to come, if that indicator turns more negative as money managers in that survey get a little more defensive. But for now, it's basically suggesting no real change in allocation. And maybe that is part of the story of the growth stocks selling off, but other things doing quite well. I mean, for a bear market, if that's what this is, and again, I think it's too early to declare what we're seeing at bear market, to be totally clear. But if this is the beginning of a really negative bear market, I would say there's a lot of stocks still going up in a pretty big way. We mentioned in the looking at the market carpet, all the things that are making new all-time highs today. So, I maybe this is a rotation, right? Rotating out of the growthy stuff and into other stuff, and maybe that's what we need to be focused on. Bitcoin actively testing its 200-day moving average, currently around 82,000. Bitcoin is trading at 84,000. The 200-day slightly below that, currently around 82,000. We've been above the 200-day moving average since mid-October of last year, so about last 5 months or so. I would say a break of the 200-day would be a pretty, be the latest bearish signal, I would say, from the chart. The breakdown of 92,000 was kind of the main sell signal for me. That was my line in the sand. It's broken. I think the charts certainly appears to be headed lower until proven otherwise. If the 200-day does not hold, I'm immediately looking down to that 74,000 level, which would be a 61.8% retracement of the bull market phase that we saw in the third and fourth quarters of last year. Boy, Nvidia, a big distribution day. We opened higher, and it was noticeable yesterday. On the show yesterday, we looked at the after hours trading for Nvidia, and we were sort of saying, look, not much of a change. For great earnings, the stock's not really up a whole lot. And we did open slightly higher today, opened around 135, but by the close, we were about $15 lower, down to around 120, down about 8.5%. Today's drop pushes Nvidia below the 200-day moving average. Now, the last time we violated the 200-day in late January, that was repelled, right? We saw bounces. Every day when we closed below, we would quickly see a reversion to the upside. That's what you're ideally looking for in this scenario, a whipsaw of sorts and a rotation back above the 200-day. If that doesn't happen tomorrow, and if you get more of a follow through to the downside, that sets up a very negative trend and suggests a rotation away from a distribution phase into more, or from a consolidation phase, as I would call it, to more of a distribution phase. We'll go quickly here because we're a little long on time, but I do want to take a question or two before we wrap. I would say semiconductors also feeling a little bit of negativity here. The SMH made a new 3-month low going into today's close, down a little less than Nvidia, but still down about 6.2%. That entire area of technology struggled. So now we have a lower high around 260 and now a lower low. That is Charles Dow's definition of a downtrend. We're breaking support. We are now clearly below the 200-day moving average. The RSI is pushing below 40. That's a bearish chart at this point. I would say clear distribution phase. One of my premium members asked me about home builders. What's interesting is with how rates have come down, over the last 6 to 12 months, you have to remember that mortgage rates are still pretty high, right? They're still sort of in that 6.8 to 7% range last time I checked. So mortgages have not become less expensive. They've actually remained pretty high. I'm noticing on the chart of the ITB a pivot point, which is right around, we'll call it 96, 97-ish. That actually originates, in my opinion, from a price gap back here in December of 2023. Then look at how many times that level was tested as support. As recently as earlier this week, we found support in that level. If that breaks, I would say that completes a big downside rotation. Arguably, it's already in a downtrend, to be clear. We broke the 200-day here in mid-December. We traded up and then tested the 200-day from below. We're now below 2 downward sloping moving averages. So I think this is a chart in a downtrend. The question is, does it hold this kind of next price objective, this pivot point? And if not, I think further deterioration is to be had. All signs are to distribution. This is looking like a bearish phase for home builders. And despite what you think might happen with rates, home builders currently going lower. There's some home data coming out. I think it was existing home sales. I forget what number came out. It was a flurry that I was trying to pay attention to, but coming in a lot weaker than expected. One of the names that came out of my discussion with Jay Woods, just to finish off, trying to keep it light, focus on some things that are actually making some new swing highs. Ecolab is one of the biggest weights in the XLB, the material sector. I'll leave it to Jay in our latest episode of the Market Misbehavior podcast to explain some of the technical justification here. But I just wanted to point out, in sectors like materials, we are indeed seeing new 52-week highs today. Raytheon RTX made a new 52-week closing high today, closing above 130 for the first time on an adjusted basis. This is a stock coming off of a higher low, coming off of a successful test of the 50-day moving average. It's making new highs above 2 upward sloping moving averages. That's a chart in a primary uptrend. So if you're wondering what to do in an environment like this, when it feels like a lot of things are bright red on the market carpet and a lot of things are going down, maybe names that have been working for you, I would encourage you to focus on relative strength. Scan for stocks making new 3-month relative highs. That's a built-in scan on the stock charts platform now. You'll find charts like Raytheon, which are actually going up and outperforming despite market uncertainty and market weakness. Let's get a question or two here. YM, thank you for watching. How do we get access to your chart lists? Some of my chart lists are available only for my premium members. And again, you can find more information at marketmisbehavior.com/premium if you want more info about what all is included. But I do have a public chart list that you can access. Go to marketmisbehavior.com. I almost just made up a website /charts, and it'll go to this chart list on the stock charts platform. This is the main chart list that I review every morning, and I keep these updated all during the week. So you can see the latest versions using that URL, marketmisbehavior.com/charts, or just bookmark this site. If you're a stock charts member, you can save these to your own chart list. You won't get the updated versions from me anymore, but you can save them to your own lists and use them and tweak them and do whatever you like. 3P Investor, thank as always for watching, my friend. And you asked PCE data tomorrow. If it is good, markets may bounce, and that's 100% true. I think what would cause this downtrend to not manifest itself any further? You need an upside surprise. I mean, I think the problem is we're getting a lot of news headlines about additional tariffs, a lot of things that are weighing on the market for sure. And things that should be boosting the market, like Nvidia, one of the biggest companies in the benchmark, having great earnings. That's not enough to push the market higher. So that tells you where we're at as an investing community, I think, in terms of our general sentiment levels. We saw the AAII survey, which I think tells the story very, very well visually. Good data, good PCE data, which is one of the preferred methods or preferred data series by the Fed to gauge inflation, absolutely could turn the market higher. There's no shortage of things that could turn the market higher. Problem I have this week so far is things that were on my list of things that could turn the market higher. Literally none of them have been able to do so, and that's kind of an issue, I would say. Titus Ryder, thanks for watching as always, my friend. And you asked, doesn't March usually bring in the bulls, or is that just BS folklore? So there are some seasonal tendencies to think about for sure, and I'm making a note to dig into that a little bit more. Maybe I will include, actually, you know what I'm going to do? I'm going to tell you this. There are some seasonal tendencies to talk about. I'm going to save that for our all mailbag episode. I might start with your question and go from there, because I want to spend a little more time than we have time for today to go into there. We actually can look at seasonality on normal years. We can also look at on only post-election years, which is what 2025 is. We'll look at both together on the show tomorrow, so don't miss that episode, and we'll do it together. Thanks for that great question, by the way. Folks, I want to thank you so much for watching. As a reminder, the Market Misbehavior podcast is lighting up with some great episodes. You can find those on my YouTube channel called Market Misbehavior. Thanks so much for all these great questions. We're planning an all mailbag episode tomorrow. We'll briefly update the market conditions and then focus on some of the great questions you guys have been asking on this show in the last week. I did, by the way, get all the 4 interviews that I did at the Money Show. I just got them earlier today. I'm going through the videos and trying to edit them up as quickly as I can. So hopefully starting tomorrow, every day or two, I'll release a new episode. 4 great conversations there that I think are still very relevant, talking about rotation, talking about leadership, and where we could find opportunities. And I'll share those insights and expert suggestions with you as quickly as possible. For now, I will say thank you so much for watching. I appreciate you supporting me and Market Misbehavior. I'm Dave Keller. And remember, it's always a good time to own good charts. Have a good night, folks.